So today we're going to go over RateX. Now, RateX is one of the leading interest rate trading platforms on Solana. And so we're going to talk briefly about how these interest rate trading platforms work, and then we will talk about RateX specifically. If you haven't already read up on how interest rate trading works, it's essentially creating fixed rate instruments out of variable rate underlyings. So let me break that down. Within crypto, the base or most prevalent form of yield is a floating rate. The rate's always changing based on supply and demand. However, there's lots of needs for fixed rate instruments, and we see that when we look at TradFi, where the vast majority of fixed income instruments are just that. They're fixed income. They're fixed interest rate. These would be your government bonds, your corporate bonds, so on and so forth. But in crypto, there's not really a concept of fixed rates. And so these interest rate protocols stand to solve that. So the way it works is you take a floating rate instrument. So let's take $1 as an example, one stablecoin, and you deposit it into a contract. And let's say that stablecoin is generating 5% yield. And let's say this is a 1-year contract. The contract will lock the token up, the underlying token, the one stablecoin, and it will split it into two separate tokens. You'll have your what's called the PT, or the fixed rate token, and the YT, or the variable rate token. So the PT stands for price token, is going to be issued at a discount. So let's say it's a 5% yield underlying. The interest rate is 5% on the fixed. It's a 1-year maturity. So if you put in $1, you're going to get fixed token, a PT token worth 95 cents. And over time, that 95 cents is going to converge to $1. And at maturity, you make your 5%, roughly. But you got another 5 cents of value. Where does that go? Well, that goes into the YT. And the YT basically generates any kind of difference in yield. So 5% is paid out. The YT would also generate, say, 5%. But if rates went up, it would generate all of the delta. And if rates went down, it would generate less, which would be, a lot less because it's levered. Now, that in of itself is very interesting. However, what's been the real flywheel, the real catalyst for these interest rate platforms is points. So many projects issue points as a way to distribute their token, their governance token, once they launch. So the way these interest rate protocols work is all of the points flow YT to the variable rate. So what that means is if I have one stable coin and it's generating 1 point over the course of a year, and I put it into the interest rate protocol, the 95 cents now generates no points, just yield. And the 5 cents gets the 1 point associated with that one underlying. And so now I've just created 20x leverage on the points. So I could, with $1, buy a whole lot more units of the 5 cent thing, 20x more. You could buy 20 of those units. And then I would have exposure to 20 points instead of just 1 point. So this has been a real catalyst for these markets and has created a lot of demand for the YT tokens for people who really are excited about a specific project and want max exposure to those points. So that in a nutshell is how these interest rate markets work. So now let's take a look at RateX here. So we can see here, we've got the different markets. And let's take a look at I'm going to use the USD star market, the Perena market. We're going to jump into that. So we'll go to the leverage tab. And this is the variable rate instrument and the points exposure. So we can see 31.5 roughly X points exposure. USD star, we can see here about 35X points exposure, maturing in about 90 days. So we're going to go ahead and buy some. Now, unfortunately, I don't have any USD star. So I'm going to do that real quick here. Oops. All right. Buy some on Jupiter. Boom. Purchased. Okay. So now I'm going to go here. There we go. Shows up. So now I'm going to buy some of the YT token. So we can see here 1600 YT USD star. And this is how I get so much extra exposure to the points, which is pretty cool. So I'm going to go ahead and do this. All right. And boom, I've got a whole bunch of points exposure here. Pretty cool. So now we're going to go to the Earn tab, and we're going to show the other side of the market. So we've got the USD star. And let's say I wasn't interested in the points, didn't really know anything about Perena and USD star, didn't want exposure to the points. And I was like, you know what? I just want to lock in a fixed 11.69% yield. That sounds pretty nice to me. So I could go ahead and do that. So we're going to go ahead and buy another 50 bucks worth of USD star. And I'm going to go ahead and lock that in here. I've got my USD star. I'm going to go ahead and deposit that into the 94-day maturity instrument, maturing at the end of March. So we can see here, putting in $48 or 48 USD star, and it's about worth 50 bucks. I'm going to lock in a yield here. Great. So now we can see, got 50 bucks here. Let's go ahead and look at it. Dashboard here. And let's look at the position. So if we look at the USD star market on the earn side, let's see. Here we go. Great. Okay. So now, this is what I was looking for here. So on the USD star market, we can see the PT price over the last few days. So we can see that it's been rising by some pennies every day. And it's going to continue to rise until it reaches $1. Now, it might fluctuate a little bit up and down as more people buy it or sell it, but generally speaking, it's going to approach 1 by the end of March. So again, this is that zero coupon, no interest paid effect, and it's just the price appreciates over time. Now, looking at the other side, we can see the price of the YT. Now, the YT does pay yield, and it also pays out points. So it trends towards 0 as maturity approaches, and it becomes worthless because there's no more interest to be paid. There's no more points to be received. So we can see that kind of inverse relationship shown here. So what we've done is we've put some money into both sides of the market, into both the YT and the PT side. But now let's go ahead and do the liquidity side. So I'm going to go ahead and unwind. So I'm going to withdraw, get my USD star back. I'm going to sell it back, just turn around and do the opposite of what I did to get in. Pay a little bit of a fee here for that instant liquidity rather than holding to maturity. Great. And then we're going to unwind the YT position as well. We're going to sell it, get some more USD star back. So we'll have about 100, maybe 96 USD star after this is all said and done. Okay, so I'm going to trade it. Great. All right. So now what we're going to do is we're going to go into the third side of the market, and that is the liquidity side. So let's say, for example, you don't have a view on the USD star points, and you don't even necessarily want to lock in a yield. You just want to, in all scenarios, whether the points are worth a lot or a little bit, you want to generate a little bit of extra yield. What can you do? Well, you can provide liquidity into these markets. And right now we can see the liquidity, the APY over the last 7 days, based on the trading fees included, is about 16%. So it's actually higher than if you held either one of the positions on their own. Now, of course, either of those positions can move, right? The rate could tank and then the fixed rate was great because you locked it in, or the points could be worth a lot. And so then, of course, you might have missed out on those if you versus going all in on the YT. But kind of across the board, as it stands today, the liquidity pool is going to generate more yield. And why is that? Well, that's because of the trading fees. So we can see right now there's about 500K of liquidity, not huge, but it's enough for folks of smaller size to enter. But over the last 7 days, there's been about $9,000 of volume. So again, not huge. Let's look at the 30-day number maybe. It's a new market, I guess. So last day, 2,000. So again, pretty small, but those trading fees that are charged are being paid to the liquidity providers, to the LP holders. So what I'm going to do is I'm going to go ahead and allocate some of my USD star to liquidity here. And this will help me to capture my pro rata slice of those trading fees. So the LP position is a great way to generate yield over and above what you're already getting from the native asset if you don't really have a view one way or another whether the points are going to be worth a lot or whether the fixed rate is the way to go. You can supply liquidity and generate these extra yields. Now, the way the liquidity works is you are providing liquidity, as it sounds, to traders that want to buy YT or want to buy PT. So in the earlier part of the video, when I was buying both PT and YT, I was trading against a liquidity pool. So there's a pool of the YT and the PT tokens being held. And if anybody wants to buy either of them, they will trade against the pool. And so you pay a fee for that, and liquidity providers get the majority of that fee, or in some cases, all of that fee. And so it's a way for them to generate yield over and above what's happening on the underlying asset. So that's a quick bit about RateX and interest rate trading. So thanks for listening to this video. See you next time.